The most dangerous move after a stop loss. Now, there can be multiple moves after we get stopped out, but as per my experience, I think this is the one which I feel is the most dangerous. In this video, I'm going to walk you through 6 sections. One section will lead us to the next one. And as we reach towards the end of this video, you will understand why there is such an importance of trading psychology when it comes to trading and investment decision making. So if you're curious, join me as in this video, I walk you through the most dangerous move after we get stopped out. Now, in this video, I'm going to use my iPad. As you can see, I have most of my homework done. Step number 1 is section number 1. What is the very first thing you feel like doing after a trade hits stop loss? Now, over here, I have to take a small little detour and make an assumption. And the assumption is this: the content of this video is applicable for someone who is a methodical trader, someone who uses stop loss. Buy and hold investor will never be able to understand or kind of connect with this content because he or she probably has never used a stop loss. So, assumption behind us is these content is for someone who's a trader and he or she uses a stop loss. So, going back to the question, what is the very first thing you feel like doing after a stop loss gets hit? Now, see, stop loss getting hits means bad feeling. Now, I say that for a trader, it's a double whammy. It's actually double bad feeling. There are 2 reasons for that. Let me walk you through that. Reason number 1 is, of course, a loss or lesser profit. I may be trailing the stop loss and my trail stop loss get hit. I could have made a significant profit, but I'm making something lesser than that. So it can be in a profit, it can be in a loss, but always it comes with a mild, bad, sad feeling. That's number 1. And number 2 is when a stop loss get hit and I'm in a loss with that stop loss, my trade has gone wrong. So my anticipation, my expectation from that particular trade have also gone wrong in the trade, and that's why I'm paying the price of the loss. So, of course, it's a bad feeling. And in that bad state of mind, a lot of people can land up doing a lot of things. Trying to fix or optimize, as you can see over here, trying to fix or optimize the setup immediately is one of the very common thing that I have seen across my mentees, or something that I also, used to do earlier. The trader starts asking questions like, so I have these 3 strips. I'm going to, walk you through one by one. So I'm a trader, a methodical one. Let's say I've traded some kind of a strategy setup. I've taken a trade. My stop loss gets hit. So let's see what's in the first strip. What if my stop loss was a little wider? Do let me know if you, connect with this. Oh, only if I had kept my, stop loss a little wide, I would have saved this trade. Especially in situations when the price comes, touches your stop loss and reverses. It makes you feel really bad, angry. The second one, what if I waited for one more candle? Right? This is where we talk about, should we wait for the price to close below the stop loss, beyond the stop loss, and then take a call? Can I just wait for another candle? Can I wait for 1%, 2%, 3% more beyond this? So there are various things. Only if I could have saved my trade. What about the third one? The third one is, what if I added one more filter? What if I added some more extra to my stop loss rules? Maybe change the parameter of my indicator, and it would have probably saved my trade. I would have probably not got hit. So, of course, these kind of questions immediately comes to mind. As I am discussing these pointers with you, I kind of, go back to my past 10, 15 years back when I was just starting into this obsession of creating various types of setups. And yes, whenever a setup kind of hits the stop loss, I used to feel that, how can I fix it? only if my stop loss was wider. Let's increase the parameter of the super trend or the volatility indicator, whatever I'm using. But you know what? If you think in these lines, if you continue to think in these lines, um, it leads you to a certain state of mind, which is on my page is this yellow arrow. It's a hidden note. Let me open that hidden note for you. So whatever we are thinking is logical. There's nothing wrong in it. What if I could have just opted for a wider stop loss? What if I just wait for the close? There's nothing wrong in it. It's actually a very logical and natural way to think. But here lies a trap. As you can see, I've written, here lies a trap. What is that trap? The trap takes us to section number 2, wherein the trap I'm talking about is we get into a vicious cycle very soon. That mindset is natural, logical. But if we continue to follow it, we tend to, get into this vicious cycle. I have 4 strips over here. Let me walk you through these 4 points. Point number 1 is the setup has too many rules. You know what happens is you get stopped out. You work on the indicator. You probably added another filter. So you're trying too hard not to get hit. Correct? And as you walk this path, you will change. You will add. Rarely will you reduce anything, but you will add. And soon you will realize that the way you used to trade earlier, you're kind of deviating and you might have too many rules now. Point number 2, entries feel confusing. This will happen because as you keep on improvising, as you keep on changing, and if you get hit, of course, the confidence comes down. The entries, you can tend to, question yourself. Should I take this trade? You don't have that kind of conviction which you used to have earlier. You're working too hard. The mindset is towards not getting hit. And that's why you're working too hard on your system. The third point, as I was saying, the confidence drops. Of course, if the system is complex, because it has become complex because you want to safeguard yourself, one indicator may be telling you it's fine to go long. The other one is telling, no, let's be a little careful, cautious. The other one may be saying, no, this is not the right time to go long. And over that, we use our intuition. And so confidence drops. The fourth one, and nothing feels repeatable anymore. Nothing feels repeatable anymore means you created a setup. It was a set of rules, formula, which you had decided to repeat over and over again. But once you get hit, or a couple of times, that drop of conviction, confidence makes you walk a different path. And the vicious cycle of adjusting and rearranging different types of approach. Maybe I will stop becoming a breakout trader. I'll become a contrarian trader, this and that. It's a vicious cycle. We go round and round. It's a very common thing. I think any methodical trader who is in the business of creating proper setups for himself and trading them will 100% go through this cycle. So what is this yellow arrow telling us this time? The yellow arrow is telling us that now it has become a mind game. Earlier when we started, we created a setup. We started trading. We got hit. Now we started to change, improvise. And soon we realize it's not about the market anymore. Then we soon see that couple of trades, as per our previous setup, had worked really well. But I did not take them. Why? Because I've changed my rules. So it has all of a sudden, rather than becoming a trading setup, has kind of become a mind game. Do let me know if you agree with me in section number 2. Now we are in a stage where we are trying too hard. Maybe ego. We will get to know this. And how do we come out of it? What should we do? So this mind game stage from section number 2 will now take us to section number 3. I have 4 boxes. What is really going in the trader's mind? Now, these are my thoughts, which I think is how a trader thinks, what he or she is, going through. Shall we take a look at it? What is the first one? The first one is illusion of control. We think that we can control everything or most things. It's partially true and partially not, mostly not. And it's from the very nature of our being that we want things to be very predictable. There has to be a certain degree of certainty, and then only we will have that conviction. And that's why the backtesting gives us that confidence. Oh, in the past, last 10 years, this is how it had played out. So it means in the next 10 years also, it will play out more or less the same way. So, some degree of certainty. If I tell you, setup A has been backtested for the last 25 years, these are the numbers, etc., etc., etc. This is how it works. Vis-a-vis setup number B, a setup which I have not backtested at all, but this is how it works. This is what it does. These are the pros and cons. I'm certain that you will opt for setup number A and not setup number B if you want to go for the next, let's say, a year or 5 years to trade. Correct? So we all naturally seek a certain degree of certainty, certain degree of, okay, this is how it should play out. And so I should be able to control things. Now, sadly, we are dealing with financial markets. Now, financial markets, they have a pattern, but they have strong emotions. It's sentiment driven market. It can be equity market, commodity market, anything. There are fundamentals behind it, but the demand and supply is kind of overlapped by, sentiment, market sentiment. And so at times, and many a times, prices go crazy. What you think and what happens is completely opposite, and you want to control it. So this illusion of control, that I will create a system which will go right or will go right most of the time in all kinds of markets. That's an illusion. It doesn't exist. What about point number 2? Ego protection. I just mentioned this word ego earlier. Ego protection is when you get hit, when you get hurt. Yeah, you want to come back. Now, please understand, this is not a video game. This is not even a sport, or you're not an athlete that you're playing the same game over and over again in the similar kind of a ground. Over here, the ground changes, a bull market, a bear market, a volatile market. And so it's best to keep your ego aside. In fact, it is a good idea to keep your ego aside in all kind of stages in our life, be it financial market trading or not. So ego protection, you want to protect your next trade. You don't want to get hurt. No one wants to get hit. No one wants to close a trade in a stop loss. But then the ego protection part makes you redo on your system and change it all over. Point number 3, outcome bias. You're too biased on the outcome. I see this very, very common thing. Many students ask me that this in the setup, am I right? And then I will always, tell them that in the market, there's nothing right or nothing wrong. In fact, in life also, there's nothing right. It's all relative, duality. So you want to be as much as possible sure that this trade should work. As if someone who has 20 years of experience will tell you, yes, everything's fine, it should go right. As if it will go right. No. In fact, I say this in my classes also. After 20 years also, I think I'm still 50-50. Still, I keep that back of my mind that anything can happen, and does actually anything happens in the market. So you have to stop thinking from an outcome bias point of view and more from the prep bias point of view, more from the preparation. This was my set of rules. Did I follow my set of rules? I get a trade. The trade comes with this much risk. Does it fit my profile? Yes. Go with the trade. Outcome bias will make you filter and filter your setup all over again. You will leave the trades, they will work. You will not leave those trades and take those trades, they will backfire. Again, a vicious cycle over and over. Do let me know if you're connecting with me. And the 4th point over here is confusing variance with flaws ego. This is where we think that we are trying to fix a flaw, as if the setup was wrong. Again, there's nothing right and there's nothing. It's just a setup. It's just a set of rules. It can be a breakout rule. It can be a contra rule, whatever it is. It's a set of rule. Of course, the set of rules should be robust enough, should be sensible enough. But every setup will have certain flaws. That is, If I'm trading a breakout strategy will not work in a choppy market. In fact, most of the setups will tend to not work in a choppy market, provided you're doing some kind of a short term contra. But the point over here is confusing variance means that if you take up any strategy under the sun and if you try it out, you back test it or you front test it, you will see that law of averages. 60% of the trades will be average profits and loss, and there will be fat tails. It's like a normal distribution curve. The fat tails where you'll get some big profits and some unexpected big fat losses. Right? This is more or less how it's going to come out. No matter what you do, no matter how much improvisation or changes you do, you will land up with, alongside variance. So you have to understand that the game is not about being right. The game is somewhere else. So what is the game all about? Can we see the yellow arrow this time? And so from the mind game, which was earlier, now we have come to emotional optimization. We're trying too hard to feel good. We're trying to kind of control the market or control our trades. Our trade should give us that ego boost. See, I went right. See, I made some profit. My entire month I made money. These kind of high ego feelings is what a trader seeks. And now, all of a sudden, from being a methodical trader, now it's become more like emotional optimization. I should feel good end of the day, end of the week, every time. So it's now a different game now. It's not about trading anymore. Section 3 will take us to section 4. Over here, I also have 4 boxes. And why this kind of optimization fails? See, earlier we discussed that it's logical, it's natural. We fall into this trap of trying to fix it. It's completely fine because that's how we have grown up. If there's an issue, if something didn't go right, let's fix it. So there's nothing wrong in it. But why such an optimization phase? Trip number 1 is overfitting, curve fitting, which I used to call. You're trying too hard. Can I use 55 EMA? Can I use a 55 period relative strength? What's wrong with 45? What's wrong with 65? What's wrong with 71? So there's no such holy grail. And so traders will say that, this parameter or this indicator. Long time back, I had shared a video long time back on 89 EMA. It's a really nice magical number. But like any EMAs, like this 89 EMA, any EMA will have its pros and cons. If you want, you can take a look. Maybe I had shared this some 7-8 years back. 89 EMA combination on the highs and lows. But that's not overfitting. That's just an idea of the trend. Overfitting is trying too hard not to go wrong. Let's take a look at the next strip. Smaller sample size. Smaller sample size means you figure out a setup, a strategy. You've done some 1, 2, 3, 4 trades, just 4, 5 trades, and then you come to a conclusion. This is dangerous. In fact, many a times I've seen that people will just take one trade, will learn and say, okay, this is the setup. Fine. Sir, I took this trade, but it went wrong. There's something wrong. We should try and fix this. This is not working. A small sample size. We know the solution of this. We'll come to that. Fragile systems. This is what I mentioned earlier, that the system has to be robust. I got myself into system development back in 2010, which means around 15 years. And it has been a continuous journey, and it will continue for the next 15 years and more. And I've understood something, that the system that you are developing should not fit into the charts, because the charts are bullish charts, bearish charts, very, very choppy markets. Your system should be simple. It should make sense. If you want to explain it to someone who just stepped into financial markets, even he or she should understand it. It should have a story behind it, and it should be robust. And so 15 years back, I couldn't develop that. I started with breakouts and this and that, and tried to improvise and improve. I've gone through the vicious cycle over and over and over again. But now I see at the border of the vicious. I also improvise. I also change a little bit. But these changes for the last, I would say, 6 to 7 years has been more of unlearning. That is simplification. You build it and then you chisel out of it. So don't create fragile systems. Don't trade a setup or a system which you don't understand. You should be able to understand what you're doing. The fourth strip is constant self doubt. This is again very similar to what we discussed earlier. You seek certainty, you know, then only you will take the call. And in the classes, I mentioned that it's always good to take a trade and learn from the trade rather than skip the trade. The classes, mentees ask me that, is my reading fine? And I say, yeah, it looks fine. But then, sir, this, I'm not too sure. So generally, my answer ends like, it's always good you take the trade, half the quantity, take small risk. Take the trade, learn from the trade. If it goes right, fine. If it goes wrong, you learn something. Because you will only learn by trading. You will not learn by optimization, by reading books or learning, from courses or mentors. Doesn't work. It helps, but it doesn't work. Right? So constant self-doubt is very important. You need to come out of that. Yellow arrow here as well. What does it say? The trader is now trading emotions disguised as logic. I hope you understand. This is a little deep. Now, if you have figured it out from section 1 to section 4, the transition of our thoughts have now come to a point where if you have ever lived this path, you will know that, yeah, I've landed up kind of working on my emotions more than working on my systems. So the trader is now trading emotions. He doesn't want to feel the bad feeling. He only wants to have good feeling. It doesn't work. He keeps on working at it. It comes back to him more. And he thinks that he's using logic. No, the variance is the logic. The normal distribution is the logic. Section 5. Oh, I have 4 boxes with 4 different rules. Now, what should be the ideal response? Not bad. If we have understood the issue, the situation, I will not call it a problem, then it can be kind of sorted, not solved. Let's understand. Rule number 1, never review a system after 1 trade. In this case, I would say not even after 2 or 3 or 5 trades. Give yourself a number. I would say 30 to 40 trades, depending on the frequency of trades you do, depending on the time frame that you trade. Give yourself a good 30 to 40 trades. If you want to give yourself some time, maybe a quarter's time. I have picked up this setup. I understand the setup thoroughly. I know everything about it. I'm going to front test it out for 1 quarter or for the next 40 trades. I'm not going to question anything in between those 40 trades. I'm going to stick to the rule as it is. Then after 40 trades or 30 trades, not less than 30 trades or 1 quarter, then you sit down and you check the sheet. Where did you go right? Where did you go wrong? Again, you will notice that few trades have average profit loss, few were big winners, few were, they got stopped out immediately, but you don't deviate from the rules. Then you take a call. This is a proper improvisation. This is looking into some bit of trades, follow in the same manner. For all you know, you might figure out that there's no need to change anything. I'm completely content with what I see after 40 trades. Let's do another 40 trades. So take a call after a sizable trade, number of trades. Rule number 2, accept the loss before entering the trade. This is in line with what I was sharing with you, that even after 20 years, when I look at the market or any trade, and if you've been associated with me in any classes, you will see that every time I talk like, yeah, this can also happen, that can also happen. Because the markets have taught me that the moment I go a little confident or overconfident that this has to go up, that's exactly when the market listen, anything can happen. And anything actually happens. Anything really actually happens in the market. And so when I'm taking a trade or when you are anticipating a move, subconsciously you can tell yourself, there's a 50% chance of me going right. There's a 50% chance of me going wrong. This is not negativity, not like a pessimist mindset. We're not talking about motivational speeches here that you're an athlete and you're going to run 100 meters. No. Let's be realistic over here. We're talking about decision making every single day and we're dealing with money. Stressful environment. So over here, we are in the field with a 50% mindset of going right and a 50% mindset of going wrong, logically, nothing to do with, pessimism, and you're a pessimist. You're losing the game before the game starts. I'm not losing the game. I'm just preparing my mind so that I can play the game for the next 39 trades or the next 3 months, right? Rule number 3, review the process, not the price. Means when you are reviewing after 40 trades, just check in how many trades did you actually, did you stick to the process or not? You're disciplined or not? Did you make any changes here and there or not? Not the price. You can't do anything much about the price. Not the indicator, not that rule or that rule. Just check, this was my set of rules. Did I stick to the rule or not? A very simple analogy will be, you're putting an alarm at 5 a.m. in the morning to get up for the next 3 months. Just check every time you pick up your phone and check that every time, did I wake up at 5 a.m. or not? Or did I hit the snooze button? Simple. Over here, rule number 3, review your process. Now, let's be realistic. In the process of 40 trades, you might bend the rule. You might get a wonderful profit. You would like to book out. So book out. You can put a star mark and mention, I booked out early. A time might come that you don't want to wait for the stop loss. The markets all of a sudden is coming down. There is bad news everywhere. You know this is going to get hit based on your experience. So you kind of bend the rule there, or you broke the rule, whatever you call it. Put an asterisk mark and mention that I felt that the market was coming down and I did not want to keep my trades open. I took off. So review the process. Later on, when we look at it, we will be able to understand how we personally feel when the trades are on. Agree? And then we go for the next 40 trades. Rule number 4, separate trading from system design. Separate trading from system design. System design is the research, is the brain work. Trading is the execution. You would have probably heard me earlier saying that try not to take decision during market hours. Market hours is more about execution. You can leave it to a computer to do that. But designing a system is your brain power, is your brainstorming, your experience, your improvisation, your research. It's you. The system design, the setup is essentially a reflection of your experience and your thought. And so you will tweak it, you will improvise it, you will optimize it, but in a logical manner, in a spread or span of, like, let's say 40 trades or 50 trades. Whatever you decide. It should not be less than 30 trades, and in terms of time, it should not be less than 1 quarter. Right? Do let me know these 4 rules make sense, but I also have a yellow arrow here as well. What does it say? A mental shift, quote unquote, maturity. By the time you've reached here, if you've reached here with me, you will understand that trading is not about strategies and indicators and softwares and fundamentals or technicals or quants. Trading is a little bit about everything, and it encapsulates the main thing that does it is the trading psychology. Our own personality, fear, greed, everything gets reflected in our decisions. You'll agree with me. And you can only understand this. You will only be able to understand and value this with a certain degree of maturity. Which takes me to the last section of this video. A mental shift is needed. Now, I have all the points jotted down over here. A mental shift can only come with time, to be honest with you. If you're new into the market and you know everything about all these things, still you will have to walk the path. The journey will only mature you. Nothing else will mature you early. If it does, then you will not actually value and understand it. So those who have walked the path for some time, you will get matured. You will understand why trading psychology is so important. So what are the pointers which I have here? So the next time a trade hits your stop loss, don't rush to fix anything. Don't open 5 indicators. Don't redesign your rules. Give yourself, see, if you're a methodical trader, if you already have some rules, you should also have some rules. When will I evaluate my rules? I have a set of rules. When do I look back into the rules? That rule also you should have. So as I said, around 40 trades. Just ask one question. Did I follow my process or not? Very important. Stop loss hit. Did I stick to my discipline? Yes. Okay. Big deal. Trade next trade. Did I stick to my rule? Yes. Next trade. And after those 40 trades, do you evaluate? If yes, move on. That's what professional trading looks like. You just move on with the next trade. If this video has helped you, share it with a trader need to hear this, because I'm pretty sure that lot of us would have walked through this path. Lot of us probably are still working to fix the setup. I'll end this video by sharing my thought process. Whatever I shared with you, I have lived through that. And that's the reason why probably I'm in a position to share with you in such a detailed manner. However, a time did come in my career when I realized that it's more about less things than more things. And so, if you've been associated with any form in any of my programs, you would have noticed that particularly over the last 3 to 4 years, a little more than that, I have been cutting down. My system, my strategy, my charts are much more leaner, cleaner, specific, clear. And this is the journey that I would like to continue further. But before that, I had to go through the process of all that I had shared with you in this video. So do share this video with fellow traders, or you think that in your community this video can add some value. You also do let me know what are your thoughts about these 6 sections that I shared with you. What has been your journey, and what is the key learning or the tipping point or the turning point in your career as a trader or as a career as an investor. Right. Till then, trade well, stay disciplined.